Hey, everybody, welcome to the Sense of Things. And this will be an interesting week because we're actually going to have two separate shows. So make sure that you watch this one, but then you turn around and watch the next one because we've got a lot of good stuff. Ron's going to run this show today, and we're really going to focus on a lot of the kind of investor aspects of the market, understanding about whether you should time the market, be in the market, whether if you invest at the tops of the market, it's good or bad. We're going to get a lot of that today, and Ron's got some really good research that he's done on there. The second show, you need to show up for that second show, so make sure you look for that because I'm going to cover some stuff on the One Big Beautiful Bill Act for businesses. So hang tight. We'll be right back on with you in just 1 second. Hey, everybody, welcome to the show. Ron, how you doing, bud?
Good morning. As we always say, never a dull moment.
Dude.
Plenty of stuff to do. You got a good show, a second show coming up on the One Big Beautiful Bill, and we could probably do about 3 or 4 days worth on that.
Oh, God.
And I know that there are still people trying to get it out there, just digging through. Today, I'm gonna cover some earnings information, average returns, and what happens if you only invested at all-time highs. So just digging right in. It was interesting we talked about this in the last show. The first half of this year was it 2 different chapters, 4 different chapters. We started out the year pretty hot. We had the tariff tantrum, and everybody thought the world was going to kaplooey. And then all of a sudden, we had this V shape. We're at all-time highs. It's just crazy. But despite the market and despite revenues, it's earnings that people want to know. And the old expression is earnings is the mother's milk of the stocks, because you could grow the top line for a long time, but then eventually investors are going to want to know, are you making money?
Yeah.
And these two charts I thought were pretty interesting from FactSet, who do a great job on earnings analysis. And if you just take a look in the left chart, going back to the S&P earnings growth, end of quarter estimate versus actual. I don't know if these analysts are sandbagging
Yeah.
or what, but it just seems like they're consistently beating it. Even if you take a look at 3 bad quarters in a row, Q4 22 to Q2 2023, two of those three, the earnings were better than expected.
Yeah.
I don't know what's going on. And then in Q3 2023, where we really just vaulted upward, they were expecting negative earning growth, and they blew that away by almost 5.25%. That's crazy. I don't know your thoughts on this. I mean,
I
we've
don't know
talked
if it
about
either says,
analysts and market strategists for 2 years.
I don't know if it is that the analysts are really as bad as we think they are, or that companies sandbag the hell of it. I think it's a combination of both. I hear it makes me laugh at some of these analysts because what was it, Tuesday that we got CPI this week? And oh my God, look, CPI is up 0.1% above what it was expected to be. Although, if you look at some of the estimates, it was right on track with them. Oh my God, see, this is where the tariffs and all this stuff is all coming in, and we're seeing the effects of it. And then a day later, PPI comes out flat, and it's, oh, okay, we can't really say that now because that's, yeah. CPI is the effect of, okay, several months after production has started and we're here. PPI is what we're paying, what these guys are paying today, and it ain't any higher than what it was. So
No.
it's the tariffs that are happening and all this. So it's just so funny. I just, like I said, I love that. What I haven't heard in a long time, though, that used to make me laugh is when they couldn't figure out what was causing the market to drop. Those profit taking. No kidding, because more people were selling than buying. Thank you.
And taxes.
Yeah, thank you, idiots. Yeah, I really don't know. I know there are good analysts out there, but I honestly
here's the whole thing, Jeff. Yeah, of course, the CEOs and to the CFOs to a certain extent are always going to spin their yarn, right? They're always going to spin. But if you got good analysts that have been following this company for a while and know how and don't forget, they're not just going by what the CEOs and CFOs are telling you. They're digging into the numbers. They want to listen. They want to know their growth. But they should still be coming out there with it, but then they gotta, at the end of the day, they gotta save their jobs too. So,
Yeah,
hey, oh, they beat the I think it's worse, obviously, if they think it's gonna be higher and it comes in lower versus
sure.
if it's lower and it comes in higher. Analysts keep their job to say, hey, obviously there was something they didn't tell us on the good side. It's the
Mhm.
reverse that gets
Yeah,
them into trouble. The
yep.
chart on the right obviously is a bit skewed coming out of COVID, but I always thought earnings was like 5 to 6% on average annual growth, and
Mm,
this is showing over 9%. I don't
yeah,
know. But if you just take a look, Q2 2025, we'll see where we end up. They're looking at about 4.6%, which is, well, again, which I thought was where the average was if you look at the last 30,
yeah.
40 plus years.
But yeah, but this is earning surprises. So it's okay. It's basically just an extension of the chart to the left. The surprises, yeah, like I said, I think part of it is the analysts aren't as good as or they, like you said, they sandbag it down a little bit. So they always look like, hey, we said it was going to be this, and it even came in more, but they didn't tell us about all this. And I think it's a little sandbagging from the companies. How many times have we
Absolutely.
seen them, have a phenomenal quarter, and then they're like, but we're not sure what the next one's going to look like.
But remember, in Q2, they did away with guidance with the
Yep.
tariffs.
Yep.
Many of them did. Or
Yep.
we don't know, or here's the range that you could drive a
Yeah.
semi truck through.
So
So
yeah, so now
crazy.
you could see earnings surprises go through the freaking roof going forward because they're not even given any kind of guidance towards what's affecting them at this point.
But I will say the following. Look, we're all happy that market's at all-time highs. There's some really good positions. I got clients in
Yeah.
that are at all-time highs and just flying, but I'm very leery at this point because
Yeah.
the steeper we're going up, I think will be like the V-shaped pullback, which will scare the crap out of people, but
Yeah.
that will create opportunities too. I don't know if that's going to happen this summer, maybe in August
Mhm.
when Wall Street goes on vacation and trading is thin. I don't know, but all right, moving on here. Earnings and total returns. Obviously, information technology is just blowing everybody away.
Yeah.
It's funny because with communication services, if you dig in, there's a lot
Mm.
of technology in the
Yeah.
communication services.
But it's more of the cell phone companies and stuff like that versus the high tech firms.
But it's the total return I'm looking at. Healthcare,
Yeah.
which is my pick for this year and next year, is struggling. But I got to tell you, I've been watching it the last 2 weeks on
Mm.
parabolic for the
Yeah.
most part with the price action with a couple of hiccups. We'll see where that is. And of course, energy, we keep talking about this. This is going to continue to drag along, especially if we continue to drill and if we
Yeah.
decide to export liquid natural gas. Why would you be in energy? I've been telling clients
Mm.
this for about 6 or 7 years. You want dividend, great. You want growth, it's not the place to be.
Yeah. I think the interesting one, if I look at that whole chart, I think the interesting one for me this year is industrials
Okay.
because that's typically more of a value play. As we go through, if you guys watch the next show, which I'd encourage you to do, when I go through some of the One Big Beautiful Bill Act stuff for business, you'll see why industrials are doing so well and why I think they're going to continue to do extraordinarily well under this because there's just so many fantastic tax benefits for industrials in
Yep.
this market.
And the chart on the right, just to give people,
It's
a
very
sense.
busy.
Yeah. This is 2008. Okay. This is 2022, just
Yep.
to give people a sense. All this is doing based on the maximum decline that year,
Mm.
where did we end up?
Yeah.
So what we're trying to show is we had that I thought it was 21, but it was 19% decline from
Mm.
mid-February to April 8th or so.
Yeah.
Now we're already up 5% for the year. So this
Yep.
is just showing based on the trough of that year, where
Mm.
did we end up? And
Yeah.
I think it's pretty interesting because at some point, if you look at it, most years we were in the negative for the year. Obviously, there were some years in here the market just flew right out of the gate from January 2nd on, and we never went negative. But I
Mm.
think it's pretty interesting when people kind of hold their head, oh my God, we're down. Wait a minute, let's look at history here for the last 45 years. Typically, we usually don't end at the trough.
Yeah. Almost never do we end at the trough.
No.
Yeah.
And that's why I love this chart. I'm going to keep this chart to show clients,
I absolutely
use
love that.
use in
Yeah.
workshops. And I think this is probably one of the most meaningful charts other than returns and everything else. This is just showing, quite frankly, lack of a better way of saying it, volatility in the
Mhm.
market. It doesn't go in a straight line, folks. It looks
No,
like an
it's part of
EKG
the
chart.
game, and you've got to figure out as a client, you've got to figure out where your stomach is at. But I will save this chart as well because it's a perfect example. And in our business, we try and eliminate max drawdown as much as possible, which we did during this time period, and we're playing with the market. But I had a lot of clients that were calling me, which they almost never do, but it was like this massive move very quickly in a period of just a month or so. And
Yeah,
people were really scared. You've got to
I get it.
understand that there's going to be these years where you have a big max drawdown like that. More times than not, it's going to not be the end all of the year.
Yep, I got you. And my last chart is we are at all-time highs. Is this where
Yeah.
you want to really put new money? Even if you did, and God forbid, we get a yank back. We're probably going to surpass this all-time high. You'll be made even at some point in the future and
Yeah.
go from there. And the chart that we showed last week, the average amount of days that we hit new highs during the year, and obviously the worst period was from 1929. We didn't hit a new high until 1954. That was the
Mhm.
worst. But if you
Yeah.
take a look at the last 40 years, there's only been a handful of years that we were negative for the year. So
Mhm.
even if you're adding money at all-time highs, especially to quality positions, even if we get an immediate whipsaw snapback, you'll still be good in the long term, especially if you're in good quality items. So I'm not going to review everything
Mhm.
on the charts here, but this is basically just showing you during that year, if you had invested at those all-time highs, what happened? We got a snapback. What happened? We got a snapback. And then, of course, just overall returns from going in at all-time highs. What did you end up with 6 months, a year, 2, 3, 5 down the road? So it's called keep investing. And also, I'm just a US kind of guy. I really
Yeah.
don't get involved in the rest of the world. That's great that Europe is having an all-time high. They were in a malaise the last 5 to 8 years. Keep investing in the
Yeah.
US.
Japan went through a 20-year period where their market basically did absolutely nothing. So yeah, I just believe in the American economy. I believe in the American companies, and I'm the same way. I just don't, unless there's a very specific company that I'm investing in overseas that might have an ADR or something like that, I really just don't have an interest.
Yeah.
I'm not there and I don't have the time and all that. Plus, you start to get into currency changes and everything else, and it's just for me, my pea brain, it takes too much work. So
I got you. All
yeah,
right, so that's what I got for today.
beautiful.
Let's start the second show with your stuff.
Perfect, folks. We will be right back with you with another show. So make sure that you subscribe to the channel because we will do weeks like this where we do a couple shows during the week because there's just so much information out there. So we'll see you back here the very next time, which is really quick.